Seth Merrin, founder and CEO of Liquidnet Holdings. Nice to see you here at the Milken Global Conference. You were actually discussing market structure and market reform, and this has really been an issue ongoing in the markets for the last couple of years. What do you think needs to be done in terms of changing our current structure?
Well, our market structure has evolved so much, so fast over the last 10 years probably. And the question that we've always asked is, do you have market structure by design or do you have market structure by default? And we've had so many new entrants come into this market that has destabilized it. And perhaps, a lot of investors have lost a lot of confidence in how the markets work, the whole concept of it being rigged. So, there are a couple of things that I think are very important. One is that we have to make it simpler. We have to make it safe for all investors to be able to participate. We have to bring back the market confidence so that the individuals feel that this game is not rigged, that in fact it's a level playing field. There are examples like there are 57 different order types when you give an order. I only understand a buy, a sell short, and a cover. I don't know what the other 57 order types are. And quite frankly, there have been some that are so unique in their aspects that they can only benefit certain parts of this community that might not be to the benefit of everybody else. It's simplification, really.
But your industry, dark pools, have been the subject of a lot of criticism for complicating the markets, and a lot of that discussion, are the markets rigged? The bad guy seem to be dark pools. Maybe some of that has lessened now that we've had a flash crash arrest and we've had more discussion about it, but it does seem that you're climbing an uphill battle on perception.
That's true too. And dark pools, that's a terrible name for what we do. We are institutional equity trading. And remember, the institutions manage money on behalf of hundreds of millions of little people, right? They entrust their money to these people. So dark pools were originally invented for institutional traders, right? I mean, there's now a wholesale sector out there, and you need very different tools if you want to buy 1 million shares of something than if you want to buy 100 shares of something. Liquidnet is very different in that we provide an average execution size about 200 times that of the other dark pools. And what the regulators around the rest of the world are doing are saying, if you do not provide value above and beyond what can be found on the exchanges, you should put your volume back on the exchanges. One of the things that we're going to talk about is, what are the other regulators doing about that? So Canada and Australia are way ahead of where we are in terms of addressing those things. So I agree. There should not be 40 different dark pools that compete with the exchanges. But what the regulators around the world are saying is, if you do provide something above and beyond what can be found on the exchanges, that's complementary, and that's a good development. And that's what Liquidnet does.
Where do you think regulation in the U.S. will go? There is more data tracking, if you will, but what's kind of the next big hurdle that the SEC really needs to accomplish to bring back some of that market confidence that you were speaking of a few minutes ago?
Let's just take a look at what Australia and Canada have done, who have been experiencing electronic trading for far fewer years than the United States, and the SEC is lagging them. So a couple of things that they've done is they've addressed the number of dark pools, and they said, look, if you're going to execute in the dark, it should be for institutions. Do at least 5,000 shares. Immediately, half of that volume went back to the exchanges, and the exchanges have to be sacrosanct. We have to protect the pricing mechanism. The other thing that they did was, in terms of high-frequency trading, they started charging as telco providers are charging, and that is, if you're taking all the bandwidth, you should pay more for it. So a lot of this spoofing, a lot of this volume or just noise in the market has left because it now costs them money to do so. These are very simple things to address. There are precedents in other markets that have actually achieved the results that the SEC, I think, wants to achieve as well.
Do you think the cost structure for market participants, for the people buying and selling, can come down any further at this point?
I don't think that the general public needs to have a price point that's less than $7 a trade, or in some cases, 0. I think that a lot of this discounted pricing has led to other types of conflicts of interest among some of these firms. I don't think that's really the issue. I think that the issue really among the public is it a level playing field? Is there confidence in the market? And you think about the SEC's primary mandate, it's about making sure that the markets are as efficient as they can be and instilling and maintaining investor confidence. And that is where the regulators really have to come in. The SEC has been sort of a wait and see and evaluating data and not really doing as much to promote those.
Any afterthoughts after you got the fine from the SEC about a year ago? Any sort of second guessing or the second considerations the way you're doing business?
So I think that the SEC is putting a lot of scrutiny on all market participants, and I think that we've certainly strengthened our own data requirements and the systems and processes that we have in control for our processes. That fine was really about our capital markets business, and it was more of a technicality than anything else. So even so, we took it seriously, and we did everything that we can to implement a technology solution around the globe to make sure that that kind of thing never happens again.
Seth Merrin, very good to talk to you. Thank you so much for your time.
Thanks for having me.